Hey, how's it going? This is Phil Ross with Loan Go-To Guy. Thanks so much for joining us today. I have so much great information to share. So let's get the ball rolling here. Gonna share my screen. Let's see here. Hopefully you can see that. All right, there we go. So anyway, just wanted to again welcome you. This is what we call your road to home ownership or homebuyer education class course with yours truly, Phil Ross, Loan Go-To Guy, and we are powered by Doorway Home Loans. To get things started off, just want to go through a few quick housekeeping items just to kind of set the tone. Um, First off, I just want to let you know this is going to be around 75 to 80 minutes long, this presentation. We do encourage you to time block that time so you can watch it all the way through. That's usually when you're getting the best results versus popping on and stopping and going. Sometimes it takes your mind, the human brain, some time, 10 to 15 minutes to reset and get back into the flow of things. So, also want to let you know I will be providing my contact information at the end of this, just in case you have any additional questions that pop up based on some of the information that we're sharing with you today. And really best practice is to view this educational class in its entirety, and then go back when you have some free time. This is the feedback that I'm actually getting from many attendees who have attended. They said when they went back and rewatched it again, they got even more nuggets that they really didn't get the first time, because sometimes when you first watch it through, you just you don't know what you don't know, and you're trying to gather, stuff. So when you go back through the next time, a lot of times you're picking up additional nuggets, which just makes the whole process of home buying much more enjoyable for you. Which brings me to my purpose for teaching these classes. It's pretty simple. It's to really reduce the confusion that most home buyers out there have. So if you feel like you're confused or you have the fear of the unknown, you're not alone. Every home buyer at some level, especially first-time home buyers, have that same feeling because you don't know what you don't know. It's not something that you've been through before, so you're not quite sure what to expect. And with that comes anxiety. With that sometimes comes fear. Whether we outwardly express it or not, we all go through that. So that's the purpose of this class, is really to reduce the fear and confusion and give you the peace of mind that you know the information you need to know to move forward. You don't have to be an expert. That's not what this class is about. This class is about giving you the information you need to know to feel comfortable taking those next steps. So really my job here is to simplify what otherwise can be very complex, especially if you're on, YouTube or the internet and you're listening to all these so-called gurus. The reality is everybody's situation is different, and what you need is a base. So clear your mind, get all that other stuff that you've seen or heard from the internet or maybe a best friend, and let's get you the information, the real information that you need to know, so you can have a wonderful buying experience. I wanted to share with you kind of my journey, just kind of to give some context of this class. When I first started out, my wife and I were looking. As you can see, I was a pretty young dude. Actually had some hair back then, but when we were out looking, there wasn't any type of class like this when we were buying our first home, and because of it, just like everything I already mentioned, we had all those fears and anxieties, and the process was so tough because we didn't know, are we going to get the house? Do we qualify? Is there a problem? Every step of the way. And that's just not a good way to be, when you're trying to buy a house. And, everybody wants the American dream, and it shouldn't be like you're on pins and needles all the way through or drinking out of a fire hose. So what I did is somehow, some way, long story, but I ended up in the mortgage business. And once I did, I just really made it my goal to model my business doing what I'm doing now, sharing this valuable information so other folks didn't have to go through the pain and the heartache that my wife and I did when we first bought our house. To me, it was just totally unnecessary. Why not teach classes and give people the information they need to know to give them the peace of mind to move forward? So that's what I've been doing for just under 30 years now, and truly enjoy it. I think the one thing that's kept me here is the fact that I'm handing those keys to a buyer, especially a buyer who initially never truly believed that they can own a home. That's to me that keeps me keeps me going, keeps me in the biz, keeps things exciting in an otherwise somewhat monotonous business. For anything could be monotonous over time, but again, I get excited. It gets me out of the bed in the morning knowing that I have these clients who are potentially going to get the home, their first home, and get the keys and see the look on their face and talk to them and hear the excitement, all that good stuff. So anyway, I'm going to jump right into what we're going to cover today. So we'll go ahead and get the ball rolling here. I'm going to touch on the loan process as a whole. Along the way, we'll talk about some deadly mistakes that many home buyers make in today's market. We'll touch on and help you understand really what lenders are looking for from you as a buyer. We'll talk about some of the common myths and misconceptions that are out there when it comes to home buying, especially on the lending side of things. We'll touch on some loan programs that are out there, kind of talk about what's different. Why is this program a little bit different than that one? And then from a high level, really just hit on some of the highlights of the various programs. And then we'll talk about how much cash is needed to close and how your lender comes up with that calculation. So you have a little bit more clarity going in on what kind of funds you need, what's out of pocket, all that kind of good stuff. So let's get the ball rolling here. We're going to start with the home buying process. Typically, when someone's looking to buy, the first thing they want to do, especially if they calling me up and saying, "Hey, Phil, my rent just got raised $200. I'm now paying over $2,000 a month. I might as well buy a home." What's the first thing they want to do? Well, you see it on the screen there. It's attending a home buyer class. And it's for all the reasons that I just shared with you. To get that peace of mind and get a better idea of what the expectations are, what you can expect with the process moving forward versus going in blindly, like I'd say 90% of home buyers do. That's why you hear all these horror stories when you're at work about buying a home. Is because they don't know what they don't know, and they went through the same process that my wife and I did when we first bought our house, and that's no fun. So kudos to you for being here today, because this is where you need to be to get the information and get the peace of mind that you deserve when you're going through the home buying process. So once you do attend the home buyer class like you are today, get the information you need, and make sure it's a reputable home buyer class, not just any home buyer class. Then next, you want to connect with the lender, like myself, loan go-to guy. We're a lender. That lender is going to have you apply for a loan, and with that information, with the information that you provide, it hopefully will lead to you being pre-approved and getting your financing options, such as how much the maximum amount of price you qualify for on a home, how much out of pocket you're going to need to expect to bring at different price ranges. What's your monthly payment going to look like? That kind of information is the kind of information you want up front, and you get that through the pre-approval process. Okay? And the pre-approval process is free, so definitely something you want to go for. Now, assuming you do not get pre-approved, what your lender is going to do, especially if they're worth their salt and doing their job, is they're going to lay out to you a roadmap on what you need to do to get to a position to buy. Also, in some cases, you may not qualify for the amount that you want. Your lender can also give you a roadmap and what some of your options or things you can do to position yourself to get the price point that you want. maybe you only qualify for 300,000, but the house that you really covet or the neighborhood that you're really looking for, the houses are going for about 400,000. So that's what the pre-approval process does. So let's assume you are pre-approved. It's an amount that you are looking for. Next step is to connect with the real estate agent and go out and start looking at properties based on the parameters that your lender just gave. Okay. Once you find the right property, we call it mutual acceptance. It's going to be basically what this means is that the seller has accepted your offer, and you are now have written up a contract with the closing date, with the price, all that good stuff, and you are now mutually in contract. So we call that mutual acceptance. Anytime you hear that from a real estate professional or lending professional, that's what that means. Next, once you get mutual acceptance, really the next step is to have a home inspection done. Okay. Oh, let me back this up a little bit, getting ahead of myself. The reason why you want to have a home inspection done fairly soon, within days after you get mutual acceptance, is there's usually some kind of contingency in there that says, okay, I need an opportunity to bring in a professional home inspector to kind of view the house from a professional standpoint and let you know the things that are going on with the house. There's always something going on with the house. But just in case there's some deal breakers, like the house may be infested with some kind of pest or the roof may be bad. And then it allows you to either, nullify the contract that you just wrote up with that seller, or have the seller take care of certain things that allows you to go back and renegotiate a new contract to your liking before the process gets going. But assuming the home checks out okay, then after your home inspection, you're going to go through what's called the documentation phase. Now, in this phase, you're going to go through, the lender's going to ask you a lot of information, to send them a lot of information that they collected up front, such as updated pay stubs, updated bank statements, things like that. Now, in this phase, they're going to go a little bit deeper in the verification of employment, contacting your employer, get information back from your employer. There's going to be third parties that are going to do certain things, such as getting an appraisal done for you, make sure the house is worth the amount that you offered for it. There's a title company that's going to make sure there's no liens against you or the person selling the home, so on and so forth. So these items are coming in not only from you, but from other third parties, and they're going to your lender's processing team. They're packaging everything up based on guidelines that they have to have, and they're sending that information over to an underwriter who's basically checking things off the list as they have it in front of them, going, okay, kind of like a quality control person, everything checks off. You get what's called a final approval, also known as a clear to close. This means that you're all set. Only one step left, which is for you to go in and sign your final paperwork. Now, before you go in and sign your final paperwork, there's something called pre-signing. All that really means is that your lender's going to send you out what we call a closing disclosure. It's just going to outline your final numbers. So your final purchase price, your final loan amount, amount of cash you need to bring to the closing table to close on your transaction, payment, so on, and so interest rate, so on and so forth. Because sometimes things get shuffled from the time you got mutual to the time you got to the finish. So it's giving you your final numbers. If you sign off on that, typically 3 days later, you're allowed to go in and sign your final paperwork. And I say go in, but sometimes if you're unable to go into your attorney or your escrow office, they'll come out to you. They'll send a mobile notary out to you as well. That's very common, especially after the pandemic and stuff. So either way, you sign your final paperwork, and voila, your loan closes and you're a brand new home. So pretty cool thing. From the time you get mutual acceptance to the time your loan closes, varies on every deal, depending on how the process goes. The process dictates the timeline. But in most cases, loans are closing anywhere from 20 to 30 days. Sometimes a little bit shorter, sometimes a little bit longer, but typically 20 to 30 days from the time you get mutual acceptance. All right, so for the everything that I just showed you, one of the most common deadly home buying mistakes that we see is delaying getting pre-approved. A lot of folks put off taking this first step for a lot of the reasons I just shared with you. Fear of the unknown. You don't know what you don't know. And as I shared earlier, I personally feel that anyone buying a home buyer class should take a reputable home. Anyone buying a home should take a reputable home buying class. It's so important, so you have peace of mind. So the next step is to get a home buying class. Don't make the mistake of trying to put it off, or you got some information out of your home buyer class. So based on what you heard, I don't think I'm quite sure. What you want to do is, if you are interested in buying a home, take that next step and get pre-approved. The reason I say this is such an important thing, important step for you, whether you're going to buy right away, you're hoping to buy right away, or maybe a year or two down the road, is you want to get your clarity and reduce the uncertainty of where you stand as far as being a homeowner, how much you qualify for. Do you make enough income? Is your credit score okay? All those things a lot of people put off because they're listening to all these different ideologies out there when it comes to home buying, but they're not sure. I can't tell you how many times I've talked to potential buyers who have put it off, put it off, put it off, and then they're surprised. Matter of fact, I'm gonna share a story with you at the tail end of just one of those cases with one of my past clients. I say past client, but he's still my client. But anyway, so reduce clarity, excuse me, reduce uncertainty and get your clarity. The other thing is it's going to give you your personalized roadmap. So often I run into folks who are getting advice from someone who just bought. Unfortunately, their personal situation is totally different. So they're kind of on a wild goose chase or being led down here. And I'm like, no, forget everything you heard. This is what you need to do to get to the finish line, get those keys in your hand. So get your personalized roadmap. And really the best way to do that is taking that step to get pre-approved, let your lender review everything and outline what your personal steps are. The other part, the other thing about being pre-approved, I call it the Willy Wonka effect because I'm a child of the 70s, and one of my favorite movies was Willy Wonka and the Chocolate Factory. So using that as an analogy, when it comes to the home buying, if you're trying to buy a home and you don't have a pre-approval, that seller's not talking to you. They're not going to give you the time of day. You can't. So going back to Willy Wonka, you can't get through those golden gates into the chocolate factory unless you have that golden ticket. Your golden ticket is your pre-approval. Okay. All right. So let's talk a little bit about the pre-approval process. What can you expect from the pre-approval appointment? Number one is it's important that your lender goes through a questionnaire at some point. They can do it before your application, after they receive your application. But there is information you want to let your lender know to make sure you're getting the deals or the options, the loan programs that best fit you. So let your lender know such things as how soon you're looking to buy, how much cash you have on hand to put towards buying a home, whether it be towards your down payment or maybe you have some debts to pay off that might help you qualify. It's good for your lender to know that. Other things are monthly payment. What's that maximum total monthly payment that you're comfortable with, but you really don't want to go, much higher than that number? Let your lender know so they can start advising you. You may end up going higher than that number, but at least at least you've been advised. type of property. Are you looking for a manufactured home? Are you looking for a house? Are you looking for a duplex, triplex, 3-unit, 4-unit? Those type of things your lender wants to know up front. So again, they can give you the proper options based on the guidelines. Areas and locations the neighborhoods that you're looking to buy, because it could be some special programs there, and also taxes, as we'll talk about, property taxes and amenities such as homeowner association dues tend to vary depending on the areas that you're looking to buy. So once we go through a questionnaire, we'll have you fill out your application. Typically these days, that's either done online or your lender can do that over the phone with you. In some cases, if you walk into a bank or credit union, they may even do it face-to-face with you if that's what you're most comfortable with. From there, your lender knows what type of documentation to ask from you. So if you're self-employed, they may ask for your tax returns. If you're a wage earner, meaning that you're an employee, they may ask for your last couple pay stubs and W-2s, 401k statements, things like that. So once your lender is armed with that information, they're going to come back and they're going to do what's called pre-underwriting. In most cases, what that lender's doing is they're grabbing your information and plugging it into a computer called an automated underwriting system based on the loan type that you're looking for, the different loan options. And that computer or that automated underwriting system is actually going to let that lender know that yes, you're accepted, you're approved, or it's going to deny you and give us a reason why. Okay. And some cases, if it's borderline, what we'll do is what's called manual underwriting. We'll go back in and go, yeah, the computer didn't really like you, but based on these compensating factors, we're going to still approve this loan. So case by case, but I just kind of wanted to give you an inside view of what happens in the pre-underwriting process. And then we come back to you and we go over your different loan options. Such things as you qualify for this program, you don't qualify for that program because of this reason, so on and so forth. Maximum you qualify for example, is 300,000, and you may say, well, the house I wanted was 400,000. Then we can come back to you and go, okay, if you do this, or you pay off this car debt, or once you get this pay increase, or whatever it might be, or maybe you're going to add another relative or somebody on, then you can qualify for that. But at least you're getting your personal roadmap on what you need to do. Now, assuming you are pre-approved, we're also going to give you some do's and don'ts, some best practices. So from the time you got your pre-approval, your golden ticket, to the time you go out and find that right home and close on it, you're not shooting yourself in the foot. So there are some important do's and don'ts. And later on in this class, I will be talking about some of those most common speed bumps that you want to be aware of in today's market, right? So I said early on that I would touch on what lenders are looking for. So let's do it. And then for the sake of simplicity, I put it in an acronym called ATR. It's all about your ability to repay your loan. Okay. That's the goggles that your lender is looking. They're looking at your information that you provided. And at the end of the day, they're saying, do we feel like this particular borrower or borrowers have the ability to make this monthly payment month in and month out over the next 3 years? Okay. They're not trying to project longer than 3 years because they understand life happens, but really that's what your lenders are looking for. Okay. And they're using 4 main parameters to make that decision. Number one is your credit. What's your track record of repaying the people that you already owe? Okay? They understand that if you're struggling to make a $20 payment on your credit card, or some other student loan or whatever, then they're probably not comfortable giving you a payment of $2,000 for a house, especially if they're lending you hundreds of thousands of dollars. So start thinking about it that way. That's really why I put these slides in here. It's really simplified, but get those wheels churning, because the whole key is to think the way a lender thinks. think the way an underwriter thinks. Okay. Next is your income. How much do you make and how stable is that income? Okay. How much do you have coming in each month and how stable, how much can we count on those funds coming in and month out is what your lender is looking at. Okay. The third thing is your debt. Okay. And debt, it really, all that means is monthly obligations, monthly payments, and how that offsets your ability to make your mortgage payment over the next 3 years. Okay. This is why you can have two different people that have the exact same credit score, they make the exact same amount of income, but one qualifies for a $500,000 home and the other one is struggling to qualify for a $100,000. What's the difference? Debt. Okay. Meaning that the person who may be struggling to qualify for a $100,000 loan is in that situation because maybe they went out and had a huge debt, or maybe went out and bought a car, expensive car with a $1,500 payment on it, and that $1,500 payment's eating up their buying power. Okay. Which brings me to the next one, the fourth item, which is debt to income ratio. The percentage of income you have coming in each month versus how much obligations, including the mortgage payment that you're trying to get, has to go back out in debt. Okay, so that's called debt to income ratio. If you ever heard of that term, that's what your lender's talking about. Simply put, I'm just use round numbers here. If you as a buyer, or it could be one or two people, make $10,000 a month, what your lender's going to do is take 50% of that, and they don't want your number to go any higher than 50%, which in this case would be $5,000. That includes your new mortgage payment, taxes, insurance, everything included, and all other minimum debt, car loans, student loans, all that. If you have 5,000, you're okay, or 50%, because that's 50% of your total income. But if you're over, then in many cases it gets a little murky. And there's exceptions to those rules. I said 50%. Sometimes you can go a little bit over depending on the loan amount and the type of payment. Sometimes the lender wants you a little bit under that, but I'm using 50% just as this is simplicity for the sake of this class. All right. So that's it. That's what your lender is looking for. So you guys are now in the mix, but let's go a little bit deeper. Let's dive into each one of these. All right, so we're going to start things off with credit, because I know that is everyone's favorite subject here. So when it comes to credit scoring, it's important to know, as you see on the screen here, that most lenders are going to use 3 different credit bureaus to get the ball, to get things going. And what they'll do is they'll use the middle of the 3 scores, the numerically middle. So if you have one score that's 700, one score that's 650, and one score that's 600, 650 is the score that your lender is going to use out of those 3. Okay. Now, if you have 2 people on the loan, there's 2 different applicants, and one applicant's score is 650, middle score, excuse me, is 650, and the other's middle score comes in at 580. Together, your middle score is 580. Okay. Typically, your lender is going to always take the lower of the 2 middle scores, and that's the reason why sometimes you see maybe one spouse on the loan, one spouse off the loan. Is in many cases, lenders look for scores 620, 640 or higher. For the sake of this class, we'll say you really want to shoot for a score about 640. Can you get a score under 640 and still get a loan? Sure, with compensating factors, but for the sake of this class, I always tell people 640 is kind of what we're shooting for. It makes your qualifying a bit easier, 640 and above. And when it comes to things such as interest rates, there's things that are what we call loan level pricing and add-ons that make 640 or higher more ideal than being under 640. Okay, so 640 from this point is what we're going to use as the target moving forward. Again, disclaimer, sure, you can get a loan under 640, but it's more likely that you would not be able to qualify if you're under 640 score for the number of reasons that I shared with you. Okay, so I'm gonna keep moving forward. Like I said, preferred score 640. The higher you go in the 700s, if you get over it says 750 here, but 740 and higher is really the ideal number. I mean, it's really the best out there. It's considered the best of the best when you have an underwriter. When they see someone with a 740 or higher score, they're going, okay. As far as credit is concerned, this is what we call an A+ borrower. So just so you know, I just want to put this little meter on the screen just to get your wheels turning again. But key is 640 when we're talking about how lenders look at loans and let's look at credit. So let's talk about what goes into your credit score. Okay. Now, 35%, the biggest chunk of your credit score is based on payment history. So what that really means in a nutshell is you don't want to have any 30-day lates. Okay. You could be 29 days late and then do a phone pay over the phone, you're good to go. But if that payment's due on the 1st and you send it out on the 29th, it doesn't get posted to like the 5th or 6th of the following month. Guess what? You have a 30-day late, and you may think it's not a big deal because you haven't had very many, but it is a big deal because again, it counts for the biggest chunk of your score. The other thing that's even worse is that only time heals. For the next 12 to 24 months, that's really going to have a huge impact on your credit score. And there's nothing you can do about it but try not to have any more 30-day lates. So what I tell people moving forward, especially on anything that's going to show up on your credit report, such as credit cards, student loans, car payments, things like that, do not avoid any 30-day lates like the plague. If you have to, if you go on vacation and your bill was due on the 1st and you didn't get it out and you got back on the 25th, get on the phone and do a phone pay to make sure that and get some kind of confirmation that it was received versus dropping it in the mail, because everything out here is based on credit score. And just like what I shared with you, payment history, and really what we're talking about is late, takes up the biggest chunk of your score. Okay. Next, 30% of your score are amounts owed on credit cards. Doesn't say on here, I must have ran out of room when I was typing. But yeah, amounts owed on credit cards. And really what this means is amounts owed against the high limit, percentage of high limit that you can charge. So ideally, on any one credit card that you have, and we're only speaking of credit cards, not student loans or auto loans, because those are installments, doesn't pertain to this, what I'm sharing with you right here. But on credit cards, if you have like $1,000 high limit you can charge on it, you don't want to go any more than 20 to 30% of the balance, of the high limit you could charge as far as balance. Okay, so $1,000. Let's say you have $1,000 limit that you could charge on this credit card. You don't want to go any higher than 300. Okay, once you hit 301, you're beyond 30% of the high limit you can charge, and it's going to negatively impact your score. Okay, the closer you get to 1,000, in this example, or 100% maxed out, that's a maxed out credit card, really pulling down your score. The good news is, unlike payment histories that I shared with you on the first factor, on this second factor here, time is more on your side. Basically, if all you have to do is get that balance paid back down to an ideal number, and in typically 30 to 45 days, your credit score should go back to what it should go up, because you've now paid that balance back down. So keep that in mind. Just want to share with you. I'm just giving you guys little nuggets here. I probably should have gave you a disclaimer before I jump too deep into this, that don't try this stuff on your own. I'm going to share with you a slide at the end that shows you how your lender really assists you in this. So all the more reason for you to get take that step to get pre-approved versus you trying to figure it out on your own, because we have the tools that can tell you exactly what you need to do. All right. So I'm gonna keep going here. The third biggest factor into your credit score is age of credit, or as you can see on here, length of history. What this means is you want to be careful closing out credit card accounts that you've had open for years. Reason being is more weight is given to that credit card that if you've had it open 3, 4, 5, 10 years than the one that you just opened last month or 6 months ago. Okay, so what happens to a lot of people is they pay off a credit card and then they automatically just close it out. And that's no big deal if it's, a fairly new credit card. But if you don't have a lot of credit established and you close out a credit card that you've had for 15 years, you just wiped out 15 years of credit history that went with that card. Okay, so keep that in mind. Next, we have amount of new credit. That's about 10%. And this can really work in your favor. If you don't really have a lot of established credit, and you're able to open up a new credit card, it can bump your score up a little bit because the credit scoring algorithms are saying, okay, this person must be credit worthy. Someone's allowing them to open up a new account. However, this can work against you. If you get too heavy-handed, you start just opening up more and more and more accounts, especially in a short period of time. Now, that same algorithm can drop your score because now that it's on alert going, okay, wait a minute. I know this person hasn't really charged anything, but they have the ability to do so. So be careful on that. Maybe open up 1, 2 credit cards in a 90 day to 6-month window, but don't get too crazy with it. Okay. And then last but not least, the credit scoring algorithms does like a little variety. So it wants to see, some revolving credit card accounts. It wants to see some installment accounts, a little bit of mixture of the two, but it doesn't want to see that you got, all credit cards, you have all installments. It likes to see a little bit of mixture in there as well. Okay. So that's really sums up what makes up your credit score. I do want to share some common missteps, especially when it comes to home buying and credit. One is paying collections, which is probably a surprise to you, but that's why we teach these classes. So you know, because you don't know what you don't know, so. But yes, paying off collections is something you probably want to hold off doing if you're looking to buy unless your lender says that you need to do so. Reason being, because I know it's probably stirring in your head, okay, why wouldn't I just pay off collection? Sometimes when you pay off collection, keyword is sometimes, not always, but on some collections, it's coded in the system a certain way. So when you pay it off, guess what? It's showing new activity on a collection and it can drop your score. Okay? Not always, it is case by case, collection by collection, but I have had it happen. I had a client who came in on a Monday, we got her approved. She had like a 643 credit score, and she came to my class on a weekend. Next Monday, we checked out her score. She had just paid off 4 collections that week after I pre-approved her. And sure enough, her score went from 643 to 498. And I know that sounds crazy, and it is crazy, but half the battle is knowing what is what. And in her case, 4 of the 5 collections she paid off were coded in a way where the new activity, even though she was paying it off, pulled her score down. Okay, so I'm sharing this story with you so to be careful. Talk to your lender. Most lenders have tools, I know we do, that we can do what we call a what if simulator. What if we pay off this collection and the system will tell us, okay, no big deal. It could tell us, that your score will drop. It could tell us your score will go up. Point is, use your lender. That's what we're here for. Give you that information, because sometimes you can't undo what you just done, even if it's something you did with the right intentions. Okay. Next, I want to share with you a common misconception that Credit Karma is the gospel. I hear so often, well, Phil, my credit score says 760 on Credit Karma. Well, that's great, but as I shared with you in earlier slides, we use 3 different bureaus. Lenders use 3 different bureaus. The other thing to know is Credit Karma is not really a credit bureau, it's a credit simulator. It's trying to simulate what the other 3 bureaus I showed you do. So while sometimes Credit Karma could be dead on, a lot of times it's off. And so I just want you to know that, so you're not upset with your lender when they say, well, no, your score is not this, it's that, So again, so just remember, Credit Karma is not the gospel. It's a good gauge. I use Credit Karma myself because it helps me gauge what direction my credit score is going, but that's all it is. It's a gauge, okay? So be careful on that. Lastly, one of the most common credit missteps that I see when it comes to home buying, I kind of touched on it earlier, is trying to self-diagnose. Okay, I'm not going to apply for my loan because, I think my credit score is too low, or, I think I need to pay down some credit card debt because I probably won't qualify. I would not take that approach. I would take the opposite approach. Get pre-approved so your lender can tell you exactly what you need to do, so you're not wasting time doing something that you think will help you out and really it doesn't. Let me give you an example. I guess I could show you better. I could tell you. Here I had a borrower came to me a few years back, and as you can see, his score was pretty low, 480. Just like the example, he was kind of hesitant to apply. I convinced him, look, Andre, just apply so I can give you your roadmap. I have the tools to tell you what you need to do. And he was about to what Andre was about to do. He knew that his credit score was low. So in his mind, I'm about to get this settlement for $12,000. Let me take this money, pay off all my debt, and my score is going to go shoot to the moon, is what Andre thought. So I convinced him. I said, okay, before you dump all that money, all that good money into trying to get your score up, let me run a simulator and see what exactly you need to do. And long story short, what you see in front of you is a what if simulator that's telling him all he needs to do is open up a new credit card of $300 high limit, but not put a balance on it. And he had a Boeing employee credit union. His credit union had an account that he needed to pay the balance down from like $900 down to $100. If he did those 2 things, as you can see on the screen, his score is going to go up to 642. Here's the kicker. Because he had so many bad marks on his credit, it wasn't going to happen right away. It wasn't going to happen in 2 months. It was actually going to take him 2 years. So when I told him that, he almost fell off his chair because he would have been upset. He took all his money and dumped it in there, and his score didn't go up right away. In this case, we were able to save him about $11,000 of unnecessary, of lost money, and put him in the right frame of mind. So 2 years later, he was in a position to buy. Okay, so I'm just giving you this example because we don't want you to self-diagnose. We don't want you sitting on the sidelines trying to figure this thing out because you came to our home buyer class and we shared with you some credit tips. Okay, get your pre-approval done. Okay, one more thing is I need to touch on this because I hear it so often. One of the most common deadly mistakes that we see are clients putting way too much information on getting their pre-approval because they don't want their credit checked. If you if your credit score drops because you're getting a credit score, which it can, it could drop slightly. But if that's your issue, versus getting a home or getting your roadmap to a home, you're way off base. As you probably noticed, in some of the things that I just weighed out for you as far as credit score, getting your credit pulled wasn't on there because it's so minute. Okay, so please get that out of here. That's kind of a common misconception. So much more important to get a full credit pull pre-approval so you can get your own personal roadmap on home ownership, which is way more important than getting, what if my score drops 2 points, So anyway, I won't say any more on that. One other thing I actually will say on that is also know, for those of you who like to shop around and see what different lender options are out there, you have, I've heard a 45-day window. Have not confirmed that. I always say a 2-week window where you can go, just to be safe, where you can go to as many lenders as you want and have them repull your credit score and it counts still as one score. That's just with mortgage lending. I don't know if that works that way with a car loan or credit cards or things like that, but I do know that the laws have changed and they did that. So 2-week window, you can shop around, only counts as one credit pull for you. Okay. All right. So we talked about credit. Let's slide over to income, because that's also a big part of your ATR, your ability to repay that loan. Okay, so when it comes to income, lenders are looking at your gross monthly income before any taxes or benefits or deductions are taken out. Okay. Now, what your lender wants to see is a 2-year stable employment history. Okay. What that does not mean is you have to be with the same employer for 2 years. That's a myth. What it does mean is if you went from one employer to the next employer, they don't want to see any big gaps where you are out of work, anywhere from 4 to 6 months or beyond. Okay. Now, there are exceptions to that rule if you were in school, training, any kind of certification or military, even if you weren't getting paid for any of those items. Okay, that still serves to fill in the gap for you because now you're actually back to work. Okay. Also, I want to point out, if you're on any kind of fixed income, such as Social Security, maybe you're receiving retirement, pension, those things, you don't need to have a 2-year to be able to show a 2-year stable history of receiving. Underwriters understand that you'll be receiving that moving forward, as long as you can show that you receive it for the next 3 years or so. That lender will use that from day one and not require that you have a 2-year history. So I just wanted to point that out as well. Now, you may be wondering what is considered unstable income. Unstable income are things such as overtime, bonuses, maybe you are partially or fully commissioned, maybe you just went out and got a second job, or maybe you run your own business, you're self-employed. All those things from an underwriter's perspective are considered unstable income, where it could be easy come, easy go. And because of that, most underwriters are going to want to see 2 years, a 2-year consistency through various documentation, usually tax returns, things like that, where you can show that you've been making that money versus, you're just killing it with your commission or your self-employed job for the last 6 months, but all of a sudden you hit a bump or there's a turn in the market and now you're struggling and we just gave you a mortgage that you can't afford. Okay, so keep that in mind. Just wanted to share that with you. If you have any questions on that, like I said before, on any of this stuff that I'm sharing with you, I'm going to provide my contact information at the end, so you can feel free and reach out to me and get some one-on-one there. All right, next we have debt, and I just want to go over the different types of debt. You have your standard credit debt, account debt, and those are things that show up on your credit reports, such as credit cards, car loans, student loans. It'll show basically your balance and your monthly payment. and a lot of times it'll show how many months, projected months that we'll have you that are left to pay on the account. So that's a standard credit card debt. That there's also deferred payment debts. Those are things such as student loans that are not in repayment. Just know that if you do have a student loan that's not in repayment, in a perfect world, your underwriter's not going to count that into your debt ratio, but that's not the case. It's actually, your underwriter typically is going to use anywhere from 1 to 0.5% of the balance as part of your, and plug that in as your monthly payment. Okay. Collections, as we talked about, be careful paying those off. However, if your lender asks you to pay those off, feel free to do so. Also know, case-by-case basis, your lender may, if there's like a balance of 5,000 or more, your lender may plug in a percentage, like 5% of that balance as a payment, just based on their guidelines. Okay. Judgments and liens typically need to be paid in full on a case-by-case basis. You can get around having to pay off judgments and liens if you have some kind of repayment plan, but that's case by case, depending on your underwriter and your lending guidelines. All right, child support and alimony are considered debt. A lot of times they are not going to show up on the credit report, especially if it's not in any kind of collection, negative collection status. A lot of times it will show up on the pay stub or in other document. And if it does, just know your lender looks at that just like any other monthly debt. And also to know that if you're going to have, if you have a spouse who's not going to be on the loan for any reason, maybe their credit score is a bit low, still your lender's going to use not their credit qualify, but they're going to use their debt if it's a government loan and if it's in a community property state. Okay, so if you have any more questions on that, feel free to reach out to me. We can go over that. Again, that's case by case, depending on the state that you're buying your home in and the type of loan that you're getting, whether or not it's government loan, which is typically FHA, VA, and USDA. We'll cover those in upcoming slides. So let's talk about debt ratio, how your lender comes up with how much you can afford. So I'm gonna give an example here. I use $38.70 a month. This is just for example of a person's income. What the lender is going to use, as I mentioned before, 50% of that income, to typically get you a pre-approval. Okay. Now, 50% of that income is $1935. Okay. And we're going to take that $1935, which is 50% of income, and we're going to subtract out any other monthly obligations that's out there. In this case, this example, we have about $220 in consumer debt. So that brings us to $1,715, which is the maximum house payment, including taxes, insurance, everything that this particular buyer can afford. Okay, so let's take a deeper dive into that $1,715. What does a house payment consist of? So your house payment consists of a number of different things. Number one, your housing expense is what we call it. Number one is principal and interest. When you see this really means your starting loan balance, including your interest rate. Okay, so without factoring any of those other items in, that's what this is. So depending on how much you put down on your down payment is going to determine your principal balance. Okay, your interest rate is going to, the market's actually in the program that you're getting is actually going to dictate that. Together, that makes your principal and interest payment, which in this example, we're going to say is about $1,295. Next, you have property tax, which I said earlier can vary from one property to the next. For this example, we're going to say that monthly property tax is going to run about $190 a month. And that could vary, that could change. A lot of times I get calls from clients and they're going, "Hey, Phil, thought I had a fixed rate loan. Why is my payment going up?" And I'm like, probably because your property tax. And they go, "Oh, you're right. That did actually go up." So property taxes can vary from one location to the other. Just know once you close on your home, if your property tax goes up, your payment goes up. Okay. Also, hazard insurance, also known as homeowners insurance. So if you hear the two, they're the same thing. It's if someone gets injured or something happens to your property, it burns down, anything like that, you would call your your homeowners insurance company. I keep wanting to say association for some reason, and they would offset your losses. Okay, and it's $70 on this example that I'm giving you, but that depends on the loan that you're getting, and other amenities. The location of your home, the state you live in, neighborhood, that kind of stuff. How big of a house it is, all will determine that. So that number I've seen as high as 200, $300 on hazard insurance. So don't get too thrown off by the example I've given you. It just really depends on the state you're in and what the typical homeowners insurance is based on your insurance commissioner. Okay. Next, we have mortgage insurance. And mortgage insurance kind of gets a bad rap. Most people don't like it, and naturally so, because they feel like it's an extra cost. So let me give you a little bit of better context on what mortgage insurance is. Mortgage insurance allows most folks like you and I to buy a house without, putting our life savings into it, putting 100,000, 200,000 down payment on a home, especially in some of these different markets that we're in. Okay. Because typically what your lender wants to see is 20% down. Okay. However, mortgage insurance came along and they said, look, we want to see more home buyers out there, who can actually achieve home ownership without dipping into their life savings to do so, or not being able to do so at all. So what mortgage insurance does, it allows us to put as little as 3% down in some programs to get into a home versus the 20% down, allows us to gain home ownership. They take on that liability of the difference with the lender, and they pass on the premium to us. Okay, so think about that when you're viewing mortgage insurance. It's not it's an extra cost. Sure, you don't like it, but it's allowing us, meaning home buyers, to get into a home without dumping a ton of money into the down payment. Okay. So in this case, I put a 105 in there. That can vary depending on how much down payment you have, the type of loan program, credit score. There's a lot of different factors that go in there. So don't get too tied up on that example. That could vary. That's a moving target. Next, I listed homeowners dues. Now, homeowners association dues may or may not apply to you, depending on whether you're buying a house with a homeowners association, which typically a homeowners association means the development you bought in has common areas, and the association wants to get paid for that. Now, this is not a part of your mortgage payment. You typically pay association dues separately to the association, whether it's done on a yearly basis or a monthly basis. But as far as your lender views it, it is part of your housing expense, and that's why you see it on the screen here. So, this pretty much outlines what goes into your monthly housing expense. All right, so now that we covered the 4 main parameters that lenders look at, that your underwriter looks at, I want to touch on a common myth and misconception that's out there. Once you are in contract, you have that mutual acceptance, and you're actually going through the closing process. Many potential buyers, like I said, that's a very scary thing for them, especially if they haven't been to a home buyer class like you have and obtained the need to know. A lot of times, home buyers feel like they get picked on because they don't know what to expect. And just know that when you're going through the closing process, your lender, from the time that you get your contract to the time we're handing your keys, we're going to be asking for stuff. And it's not because we love paperwork, trust me. I've been a loan officer for a long time. I do not like paperwork. My teammates do not like paperwork, but it's become a necessary evil for the most part. After the mortgage meltdown of the 2008 through 2012, what happened during that time is there were mandates that came about that weren't there before. I would say rightfully so in some cases. In some cases, it's kind of overkill. But long story short, lenders, underwriters have to now answer to auditors from the state and the federal level. And at any point in time, once we close your loan, an auditor can come in, review your files. It could be 3 days, 3 weeks, 3 months, 3 years from now, and they expect to see certain documentation in that file based on your profile. And if it's not there, there could be fines issued. People could lose their job. So just know that if you can get the information your lender is asking for, they're not picking on you. They just want that information for the file. Is it overkill in some cases? Sure it is, but it's just the lending world we're in. Help us help you. Get us that information. We'll put it in your file. If it's something you can't get, verbalize that to us, and there's usually a workaround, or maybe we won't ask for it at all. But don't feel like you're getting picked on. If you weren't qualified for the loan, in most cases, we wouldn't be having these conversations with you. So don't feel like it's like, oh, am I going to get the loan? Are they trying to find a reason not to give the loan? Usually that's not the case at all. Usually it's just because we need that information. So help us help you. Okay. Now, I do want to hit on some of the most common speed bumps that happen during the loan process. Now, from the time that you got mutual acceptance and now you're trying to get the keys to your home and go through the closing process. These are some of the most common things that I see that make people shoot themselves in the foot. Similar to the picture that you see on the screen now. Some of the no-nos, which I always like to use this class as a form or a format to let you know some of the most common mistakes that we make so you don't make those same mistakes. And here they are. One of them is conflicting information. If you know something is not true, please don't put it on your application. For instance, I had a client who put down that they were married, that they were unmarried. Turns out they really were married. Usually no big deal, but in this situation, they were getting a government loan. As I talked about in the earlier slide, they were in a community property state. And lo and behold, we found out, I guess the escrow company found out days before closing that this client was actually married. Worse yet, this person's spouse actually had a mortgage, in their name that we had to factor in now at this point because they were in the community property state and they were getting a government loan, and it made them not qualify. 3 days from closing, everybody was upset. The buyers were upset. The real estate agents were upset. The person trying to sell their home, who took their house off the market, was upset, all because the proper information was not provided. So make sure you communicate to your lender, even if you have like a job change or you got a pay cut coming. We're not going to know that unless you tell us that. So try to be upfront, open, honest, as transparent as possible with your lender. It just helps everyone in the end. The next one is credit status change. Try to keep your credit status quo. Know that in many cases, your lender, even though they've done a credit pull on you, they do what's called a credit. Many lenders do what's called a credit refresh, just to make sure your score hasn't moved around or dropped below guidelines, because most loans are sold, or at least if they're not sold, your lender likes to have the ability to sell them on the secondary market, Wall Street, all that good stuff where it gets bundled. I won't get too deep in the weeds on that. But point is, if it started out at 640 and now all of a sudden your credit score is 620, that becomes a loan that's difficult for them to sell if they ever choose to do so. Okay, so keep everything status quo. Don't go out opening up credit cards. Don't go out charging anything until we get those keys in your hand. Okay. The other thing is be careful. A lot of times when people hear me say don't charge anything or da-da-da, what do? They dip into their bank account because they just ran across a great sale on some furniture that would go great in this house that they're about to buy, or appliances, what have you. Again, keep everything status quo. Guess what? In many of those cases, I've had clients who dipped into their personal funds, and then the underwriter gets a updated bank statement balance that shows that they've got $3,000 less in their account. And that $3,000 may be what's helping them qualify for that loan. Okay, so again, try to keep everything status quo is my point. Large cash deposits. Be careful putting large amounts of anonymous cash into your account. If it's traceable, if you've got a bonus check from your employer and it goes from your employer straight into your account via check or some kind of electronic transfer or whatever, fine. There's a paper trail for that. But if you've got $5,000 that your friend gave you, that they're repaying you, and you're trying to buy a house and you take that cash and put it into your account, that could cause problems because lenders are mandated to, as a fiduciary, to make sure that there's no foul play going on when it comes to home ownership. It just is what it is. We're mandated to do that. So now we see this $5,000 cash that we can't trace, and it can be a speed bump for you, can slow you up. So now we got to go back and try to explain it to the underwriter, do letters of explanation, just through unnecessary hoops that you don't want to have to jump through. So point is, if you got cash that you want to put into your account, call your lender, get instructions on how to do that properly. In most cases, if we don't need to do that, we're going to tell you to put it to the side, put it in the safe, put it in the mattress. Just don't impede the process until we get those keys in your hand. All right. If you have any questions on that, I know a lot of times I have folks who have families from other countries who send money and those type of things. Feel free to reach out to me and we can go over and get you coached up on the proper way to go about that. Another thing that I see quite a bit is if you're not a full-time employee who works 40-hour weeks and we've qualified you based on that, try to work as many hours as you can during the loan process. We've had situations where we qualified somebody who works on average maybe 25 hours a week, and all of a sudden, they get their mutual acceptance and they're sending us pay stubs during the process and they're showing they work 10 hours a week. Guess what happens? Now that underwriter wants to use only those 10 hours because you're not a full-time employee, and they don't, now that you're working 10 hours, we got that in front of us, that's what they want to use. That may be the difference between you qualifying and not qualifying at the end of the day. So wanted to put that out there. Now, if you are a full-time employee and you're taking time off and you get paid time off, no big deal. You're still good to go. All right. So my point with sharing you those speed bumps is when in question, contact your lender. That way you're not walking up on something. I'm laughing because I'm looking at the picture because it is a great analogy. A lot of times you don't know. You're just out there innocently, doing what you think you're about to do. And in this case, these folks walk up on a bear, you better start running. So we don't want that. We don't want that to be the process for you. So that's what we're here for. When you're pre-approved, contact your lender, so before you make a decision that you cannot undo. Okay. All right. So going to shift gears a little bit here too now and talk a little bit about some best practices. One being knowing where your money goes. This slide just threw me off here because this is actually a deadly mistake, which is not knowing where all your money is going, which is the case for many of us. So a lot of us just don't track our funding. You do want to know, it's all about cash flow, especially when you are becoming a home buyer. So here's some tips for you real quick. Number one is track your spending for maybe a week. Um, and what this will do is take from the back of your mind to the forefront of your mind where your money is going. Once you do that, do a spending plan. Lay out, crack open your checkbook, lay out all your normal expenses that you are spending money on, including what you project your expenses will be if you buy a new home. Okay. And lay that puppy out line by line by line. Don't leave anything out. If you know that you have medical expenses, or that you have birthdays and holidays that you typically write that in there. You may have to back it out, later on, but at least you have those things in there and you have planned for it, and you can see what those real numbers are. Then you take your income, your net income after everything is taken out, because that's the real money, that's your spendable money. And any extra income, if you have a side hustle or do different things to have other income come in, put all that in there and weigh it out. If you know that you only net about $3,500 a month when it's all said and done, but you're looking at a list of expenses that are $4,500, and guess what? You got some cuts to make, but at least you know up front what you need to do. Okay. Now, once you do your spending plan, don't throw it in the junk drawer because you don't like how it makes you feel. What you want to do is post it on somewhere like your refrigerator. Keep it in front of you. Start, make copies, check things off as they go. Over time, over 2 or 3 months, you've now conditioned yourself to live within your means, which is the best way to go, especially when home ownership is concerned. Okay. I have a few other tips when it comes to money. I am a financial literacy coach. That's another one of the things I do. So I can't help myself. I have to give you these tips. One is to moving forward from this point forward, whether you end up buying a home or not, please keep 10 to 15% of everything that you earn. Pay yourself first is what I call it. There's something about having a little bit of money set aside. That check engine light doesn't come on. But guess what? When you don't have money set aside, check engine light always comes on. It just life works out that way. So the other thing is try to put 90 to 100% of any new money. And new money is things that are kind of, you're not really counting on. It's not your base, that you get month in and month out. Things such as your tax refund. Maybe you got a bonus from your job. Maybe you just paid off your car note, and you've been paying $400 a month. Since you're already used to that, keep paying that $400 right into your savings account. Pay yourself first, or take that extra 400, split it in half, 200 in your savings, 200 to pay off additional debt each month. And as each debt gets paid off, take those extra amounts and put it towards the next credit card till you are debt free. So those are just little tips there. I got more here. One is, once you get the keys to your home, try to make one extra payment each year. And you could do that a couple different ways. If you're disciplined, I'm not. I am disciplined for probably about 3 months, and then I'll find a way to burn that money at Burger King or some burger spot, because I'm a burger guy. But if you're disciplined, basically just divide your monthly payment by 12 months, and then take that number and put that number in as an extra monthly payment amount, and you'll end up paying your one extra payment each year. And what that does is pay your house off 7 to 10 years sooner over a 30-year period, and save you, tens of thousands of dollars in interest. Now, if you're not disciplined, like I'm not, what I do is at tax refund time, I just make 2 payments, wipe it out, so I don't have to worry about doing it through the course of the year. Same effect. And I end up saving money on my interest. Even if I end up refinancing or selling the house, before 30 years, I'm still keeping more money in my pocket versus paying it out to my banker. Okay. And then last but certainly not least, once you get your keys, protect your assets for your family. Okay. I know this is, kind of a grim subject. People don't like talking about it, but if something should happen to you, you don't want your family members, your loved ones fighting over things. You already want that taken care of. Okay. So please protect your assets, put something in place, get you some type of estate planning in place that is going to take care of your affairs if something should happen to you. Okay. All right. So that does it. I won't hit you guys over the head too much more with the money tips there, but it is kind of a part of who I am, so I couldn't help myself there. All right, so let's jump into loan programs. Again, we're just going to go from a high level here. Want to explain some of the different factors of each of these different programs here. Starting with conventional, a conventional loan is really a loan that's a non-government loan. Typically, requires about a minimum of 3 to 5% down payment. It is part of the program I told you where you would put it through an automated underwriting approval on an automated system. It's either going to say approved or denied. Mid scores on this program, unlike some of the other programs, are average. So what the most lenders will do is take the average of two middle scores versus the lower of the two. Okay, so that's good news there. That was something that just came about recently. Cash reserves, meaning after everything is factored in, your down payment, closing costs, all the cash you come in with, how much cash do you have left over? Cash reserve is a strong factor. Most lenders on a conventional program want to see at least 3 months or more cash reserves in the form of your monthly payment sitting in some kind of emergency fund or savings or something that is liquid, considered liquid cash. They don't really look at. They don't want to see, oh, you've got a car, you got an auto that's worth 20,000. That's not considered liquid. They want to see liquid cash reserves, and that is factored in pretty strongly on your conventional program. Also, there's private mortgage insurance if you're putting less than 20% down, as we talked about. Now that mortgage insurance can be voided once you hit a 20% equity position, meaning that you can show that your balance and the difference between your balance and the value of your home is at 20%. Okay. All right, next we have jumbo high balance loans. And what these are are conventional loans that are above a certain amount at the timing of this presentation. In most markets, that number is anything above 647, 200, but that can vary depending on your market area. So make sure that you're talking to your lender directly on that. Now, because these loans, these jumbo and high balance loans are higher than normal, most lenders want more skin in the game. They're going to ask for anywhere from 10 to 20% down. In some cases, case by case, they'll allow 5% down or less, but just know that that's case by case. And usually that comes with a caveat of a higher interest rate or something like that, because that would be considered a special program. Okay. Also, because these are higher balances and lenders, want to make sure you're considered what we call an A borrower. So they're going to expect higher scores, 680 and above in most cases. And actually what I'm seeing now are a lot of investors on these jumbo and high balance want to see 700 or higher. If you have 680, under 700, keep in mind that lender, that program may be out there, but typically you're going to pay for it in interest rate. All right. Lower debt to income ratio. I know we've been talking about 50% debt to income ratio. That kind of goes out the window when you're talking about jumbo and high balance loans for an obvious purpose, because you're asking for more money, and that's because you're asking for more money and a higher balance. that lender is more worried about the default rate on that, and they're going to tighten up and restrict their guidelines accordingly. So debt ratio typically 43% under. In some cases I've seen as low as 38% on some of these programs. So just be aware that that is, again, case by case. All right, and higher cash reserves. I've seen 6 months to a full year in some cases as far as cash reserves, emergency funds available after the loan closes, required for some of these programs, because again, it's more loan exposure. The higher the loan exposure for that lender, the tighter the guidelines. Okay. Now let's talk about FHA, which is a very popular loan these days. Not so much because of minimum down payment, because it's pretty similar to what we showed you on conventional, but because it can be a bit more flexible in the underwriting side of things. In particular, cash reserves requirements are less stringent, and debt ratio. In some cases, underwriters will allow you to go up to 55% or even a little bit higher on a debt ratio. So what that does, it allows that person who maybe only can qualify for 350, I would say, on a conventional. Maybe if you go FHA, that number bumps up to 400, 420, 420,000. So just as an example there. So if you're wondering why one would choose one over the other, the mortgage insurance, downsides of mortgage insurance doesn't go away. It's not ever voided. So if you get an FHA loan, you're basically going to have FHA mortgage insurance. Only way that I am aware of to get out of that is to refinance into a conventional loan later on down the line, assuming the terms such as interest rates make sense. All right. FHA does allow for a non-occupant co-borrower to go on that loan for cases such as you maybe can't qualify for the amount that you desire, but if you add a relative on, maybe you can go a little bit higher, $100,000, $150,000 higher, assuming they have the qualifying credit scores that you need and the income and debt ratio that won't impede what you're looking to do. Okay. Next, we have USDA. USDA is kind of the under the radar program a lot of people don't know about, but the highlight is what you see there, the zero down payment program. Now, the home must be in a USDA eligible area, which is usually a rural area. If you're not quite sure, just reach out to your lender, say, hey, I'm interested in rural loan. USDA, does this property fit into it? And they can tell you, or you can go to the USDA website and it will outline that for you. Now, ineligible properties on this program are working farms and anything that's above 1 unit. This particular program, unless you're going directly to USDA, really doesn't want to see operational farms on there. But you can go, if you are looking to get an actual operational farm, which is considered a business loan, just go directly to USDA and ask for a USDA direct loan. Okay. Now, there are some county income restrictions based on your loan amount, how much, not on your loan amount, but based on your total gross income and the location you're buying in and your family size, how many people are in your household. So what you want to do, again, is work that out with your lender. They will let you know whether you fall into that criteria or not for USDA. All right. Now, let's go to VA. VA, in my opinion, is the best loan out there, rightfully so. It's taking care of our military families out there, whether they're active or inactive. So if you're military, really, I really encourage you to move forward, apply, take advantage of this great benefit that you have in front of you. Number one, it's zero down loan. There are no monthly mortgage insurance requirements on it. It will allow for less than perfect credit on your loan profile, which is a pretty cool thing. It is for homes that you plan on living in. If you're looking to buy under investment profile, this is not the loan you want to use your VA certificate for. The home must be in move-in ready condition. We do hire VA appraisers. One of their main jobs is to make sure the house is safe and sane for our military family. Okay. And a pretty cool caveat is that if the seller is willing, keyword is if they're willing to do so, they can actually credit up to 4% of the sales price to go towards paying off debt for these for military families like yourself. So if that is something you want to have a conversation, never hurts to ask. Just know that it's the seller's discretion if they want. It's their choice if they are willing to do so. I know personally, my wife and I actually sold our first property that we purchased, and we sold it to a military family. They weren't going to qualify because they had a few judgments here and there. We allowed to credit some of the proceeds to pay off those judgments, and it allowed that family to buy their first home. So pretty cool gesture on our part. We didn't have to do it, those key, but it's a pretty cool feature that allows many families to get into homes. So if you're a seller out there, take care of our military family. Okay. The other thing I want to point out before I move on is that your VA certificate, there's a myth out there that you can only use it once, so you better choose wisely. And that's really not the case. You can use your VA certificate multiple times. It doesn't have to just be on your first home. So that myth is out there. So if you're on the sidelines because of that reason, I encourage you to get in the game. Go ahead and get pre-approved and get your home ownership. Okay. Now, I also want to touch on reverse mortgages. I know, again, that there's a connotation out there, and reverse mortgages get a bad rap. However, in this day and time, you almost cannot, especially if you're a baby boomer, someone who's turned 62 years or older and entering your retirement years, you almost cannot afford to not look at this program. You have to consider this program, and the reason why is there's no payment on this program. I didn't even put that as a highlight, but there's no payment for the life of the loan. Matter of fact, up to you're 150 years old. Okay, so there's no credit score requirement, as you can see on the screen here. No income requirement to qualify. You can actually get this loan, whether it's a purchase transaction or refi. Refinances are more common, where a person's taking a home that they lived in for a few years, have some equity built up, and saying, hey, I'm in my retirement years, my income is being reduced. Let's get rid of this housing expense where I don't have to pay for housing for the rest of my life. Okay. Now, what happens on a reverse mortgage is the balance that you would normally pay does tack on to the loan, but ideally, your equity, your value is going up accordingly. But even if your value doesn't go up, great way to have housing. We all got to pay for housing some way, in some form. If it doesn't have to come out of your pocket in your cash flow, why not take advantage of that on a home that you've owned for so long, especially in this day and age where, people are moving into these facilities in their elder years, and it's just costing so much money. You may as well take the asset that you built into, and ride that wave, even if your balance is strong. That's just my personal opinion. Honestly, when I turned 62, my wife and I are seriously going to look into that as a benefit, because we can always make up that extra money that we're paying into our mortgage in different investments that grow. Okay, so that's you want to start getting those wheels churning there. It must be a home that you are planning on living in. That's another caveat. And the primary borrower, I think, needs to be at least 62 years or older. Now, how much you get, whether you qualify for reverse mortgage, and how much you can get out of your home. You can get lump sums, or you can set up a line of credit, but that's all going to be based on your parameters, based on your age and the zip code that you're in. And based on that information, there's calculations that are made that your lender can come back to you and kind of give you your option. Okay, so don't sleep on the reverse mortgage, folks. Please, it's there. And we're in a day and age now where people should not be passing that over just because a family member or an heir is, looking at it in a way that, hey, how's this going to impact me? Guess what? You're still here. You're still living. Take advantage of the benefits that you've invested into because you're still here. You still got to live and you still want a high quality of life. Do not pass this by without at least looking into this option. I encourage you. All right, so we'll keep things moving. I do want to touch on, before we close out, how cash to close works. How does your lender come up with the amount of cash you need to close? Because I know there are two very important things to first-time home buyers. At least it was to me when I was buying a home. Number one, what's my monthly payment? And I kind of already went over how that's broken down. The other thing is, how much cash out of the pocket do I need? Okay, so let's go through. What I'm gonna attempt to do now is kind of give you, in the most simplified way, how your lender is going to determine how much cash you'll need to close, just so you have an idea. At the end of the day, you're going to want to go to your lender and have them give you, that ballpark, that estimate at least, so you have an idea. But I just want you to see how those mechanics work. So really, when it comes to how much cash you need to close, it's really in three parts. It's your down payment, your minimum down payment that you're required to come in, plus loan costs that are from third parties, including your lender. And then there's prepaid items and reserves, items that are collected up front for your homeowner's insurance, which typically has to be paid a year in advance, that's collected up front, and your county property tax, things like that, which are collected usually anywhere from 2 to 7 months up front, depending on the date that you close. Okay, so that money, the prepaid items and reserves, I like to tell, especially first-time home buyers who were typically renters previous to that, to view it almost like first and last month's rent and deposit. Because if you do ever sell or refinance your home, your prepaid items and reserves that have not been tapped into are refunded back to you. So you'll get this check and you go, well, I wasn't expecting this. It's just money that's given back to you. But it is real money that has to be collected up front. So that's why I put it in the cash to close, because it's all part of what you want to know when it comes to how much cash you need to bring to the closing table. All right. So this is just another way to look at it. Some people are more visual than others. So down payment can be anywhere from 0. Most people put 5% down, but some people put 20% down. Whatever that number is, you want to also add that to your standard loan cost. And I just listed some of the most common items that are included in your loan cost, or some people call it closing cost. And then you have your prepaid items and reserves, which I just talked about. And in most cases, when you combine your loan costs plus your prepaid items and reserves, that actually makes up your total closing cost. But wanted to break that down for you. So let's take an example of how that works. So let's say you are going to purchase a home for about $350,000. And again, I'm just throwing a number out here. It could be way higher, way less. I just kind of want you to see the mechanics of how this works. Now, let's say you're approved on a conventional loan and you say, okay, I'm gonna put the minimum of 3% down, which would be about $10,500 in this case, okay? Next, you have closing costs, which includes your loan costs and your prepaid items and reserves. That totals right around $5,500 between the two. And total, when you count now your down payment plus your closing costs, you're coming in at this point with about $16,000, okay? Now, when you write up you put in this offer, and assuming that the seller accepts your offer, you're gonna, at some point, now have to write what's called an earnest money check, okay, to show the seller that you're a serious buyer, okay? And that earnest money check or deposit always goes towards the cash you need to close, okay? So if you wonder where that money goes, we're going to just take those funds and push them right towards the amount of cash you normally need to close. So if you come in with $2,000 earnest money, then get how much would you come in with if you had to previously do 16,000? Yeah, you're right. It's 14,000. Okay. So that is kind of a nutshell of what goes into how much cash you need to bring to the closing table and how your lender comes up with that. All right. So any questions on this, again, reach out. Know that this is just an example. Some of these numbers can vary, so don't get too caught up in them. I just kind of wanted to show you a high level breakdown of how that works. All right, so cash to close can come from a different number of sources, as you saw there in that example, about 14,000. Those funds can come from your checking, savings, retirement accounting, kind of liquid um, account that you have. It can come from a gift from a relative. Most lenders prefer that relative to be, someone who is not a cousin or uncle. And the reason for that, or uncle or aunt or anything like that. The reason for that is they want someone they feel is fairly close enough to you where you're not going to be required to repay it, because otherwise you're taking on an additional debt, which lenders don't like. All right. So the other thing is down payment assistance is another source that you can use, or a combination of all of the above. So I do want to touch on down payment real quick. Down payment assistance can be something very beneficial. They vary. Down payment assistance programs usually come from the federal government, trickle down to your local and your state offices and what they offer. So it could differ from one state to the next. And we do lend in a number of different states. So I'm going to speak in generalities here, but I do want you to know some of the most common pros and cons that are associated with down payment assistance, so you're not going in blindly. Now, the pros of down payment assistance is down payment assistance usually offsets your total down payment, which really means to you less money out of your pocket than you normally would have as a home buyer. Okay, that in most cases speeds up your timeline, especially if you're trying to save for a down payment on a particular home, and maybe you need $14,000, and with down payment assistance, maybe now you only need 5,000 or 6,000, which you actually already have on hand. Okay, so that could speed up your timeline. And typically on many of these down payment assistance programs, not all, but many, they don't require any extra payment over and above your mortgage payment. But again, that's case by case. Now, downside of down payment assistance is your interest rate on your first mortgage is typically going to be higher, because what lenders are doing, or these programs are doing with these nonprofits, is they're hedging up your interest rate because they're not asking you to come in with any money. So you're considered a higher risk loan. So they're building that into the rate. Now, when they build that into the rate, typically that means that you're going to have a higher payment than you would if you came in with your own down payment. Now, with that said, what that means is you may, in many cases, have reduced buying power. And the reason for that is with a higher interest rate usually correlates higher, a lower amount that you can buy. So it's not unusual, especially considering some of these programs have tighter debt ratio guidelines too. It's not unusual for a person who would normally qualify for, a $400,000 purchase price. Now, if they went down payment assistance, that could drop, as low as $300,000 in some cases. Okay, so just know that it can cut into your buying power as well. So also know that down payment assistance rarely covers all of the required cash that you need to close. Okay, In most cases I've seen, and there's some cases where we'll cover all of it, but in most cases it depends on how you write up the loan, whether or not the seller is going to cover any of your closing costs. So be prepared. Don't automatically assume because you're getting down payment assistance, that means zero out of pocket. Sometimes it does, most of the times it does not. Okay, usually you still have to come in with something to make you to get your loan closed. Also know, and this brings me to the next point, that typically because your down payment assistance is in the form of a second mortgage, a second lien that goes on your home, it must be repaid at some point. Usually it's when you either refinance your home, sell your home, or 10 to 30 years, depending on the program you're on, whichever comes first. Okay. So just be aware of that. In many cases, when we have down payment assistance, folks automatically think grant, and not necessarily the case. There are case-by-case programs that will, at some point, forgive the loan, meaning that they'll wipe out any repayment of it, but don't count on it. If that does happen, great. Then that's a cherry on top. But again, be aware that most of these programs do require that you repay the loan. Now I want to, before I finish up here, we're almost at the tail end. I do want to make you aware of one thing for those of you who once you do get the keys to your home, be careful. You're going to be, there's going to be some predators out there. They already know that you just went through the home buying process. They already know that your lenders probably asked you to sign a lot of official looking documents. So they're piggybacking on that. And what they're doing is they're taking public records that are now recorded at the county records, getting information off of there and trying to package that back to you as if your new lender is saying, hey, these are things that you also need. In reality, these are companies that have nothing to do with your lender, and the stuff that you're getting is junk. So what I'm telling you, 99.9% of this stuff is junk. Once you get the keys to your home, if you're not quite sure and you got an official looking letter, just contact your lender. Shoot them a quick text, take a picture of it, shoot that text over to your lender, or email or scan it and say, hey, this is what I just got. Is this real? 99.9% of the time, your lender's going to go throw that in the garbage. It's just someone trying to get your business, and they got that information from a public record, even though it's presented to you as if it's coming from your lender. Okay, so wanted to sneak that into my presentation because I get a lot of calls on that as well. Okay, but I'm going to finish things up. I want to finish things up with a story of a client that hopefully resonates with some of you, at least with you, or if not, with someone you know. Okay, I had a year or so back, I had a client by the name of Ed, who he was a military Vietnam vet, had a VA certificate for years. However, he wanted to own a home, but his negative self-talk wouldn't allow him to take those next steps. Every time he thought he might be ready to buy, he would either hear something in the news or a friend would say something that would make him just go, no, let me step back. It's probably not my lane. So he had a co-worker who actually attended one of our workshops, just like what you just experienced. And they said, hey, got some great information. It was presented to me in a way that I could understand. Ed, why don't you go? So he did. He listened. He came to the presentation. Sure enough, he got the peace of mind to move forward. Got enough information to need to know. So said, hey, let me throw my hat in the ring, see what happens. So he did. And anyway, at the time, it was prior to the pandemic that we were meeting. He had the opportunity to come into my office and we met face to face, and he brought his girlfriend with him. And as we're conversating, I slide over to him his pre-approval, and then I look over at his girlfriend and congratulate her, look back to Ed, congratulate him. and Ed is visibly sobbing, and it just totally caught me off guard because I did not expect that. So it probably went on for about 20 seconds or so. It felt like 20 minutes, to be honest with you, because it just really caught me off guard. But when he pulled himself to, Ed explained to me that he came from a family of renters and that he just never truly believed that he could own a home. And here I am, you know, giving him his pre-approval, something he thought he'd never see in his life. So story gets better. 3 months later, he closes on his first home, invites me over for his housewarming party. And it's a small little 2-bedroom home, Rambler, but it may as well have been the Taj Mahal. Matter of fact, it was the Taj Mahal for Ed. So I share this story with you because I know that somewhere in there, that story resonates with you one way or the other. And if that is you, or if that is a friend that you know, I encourage you to take those next steps. If it's a friend, have them take this class, and then give us a call and let's see where you're at. So next steps, if you're not already working with the lender, or if you're not already pre-approved, then we'd love for you to give us a shot. Simply go to our website at loangotoguy.com. Right there at the top, you'll see a tab that says Apply Today. Simply click on that. It'll take you to our home page there. You can hit the Apply Now button. It'll direct you to a site where you basically create your account so it's password protected, to protect your personal data. And from there, follow the steps, and my team will take you every step of the way. So other than that, I thank you so much for hanging out with us and clicking that button to get educated. That's really what it's all about. If you have any questions, my email address, pross@doorway.com, and love to hear from you. We're here for you. So hopefully you will feel comfortable enough to reach out. Again, thank you so much, and we look forward to working with you.